A safe and liquid 5.54% investment when markets collapse. Who is this for, and is there a catch? Hello, Diamond NestEgg members, super savers, and course fans. I hope you're healthy and well, and welcome back to our weekly update. So, this was another interesting week in the markets. We seem to have had quite a few of these recently. The S&P 500 and the NASDAQ Composite both zigzagged through the week, and Thursday was a particular roller coaster. First, Nvidia's strong results pushed the market up when it opened, but then the sentiment quickly changed and everything ended the day down. Most market analysts were at a loss to explain this violent mood swing. Maybe it was the realization that good news from the economy might stop the Fed from cutting rates again in December, but no one really knew. It seemed like the smallest piece of news could turn the market around on a dime. As a consequence, many investors who were already a bit nervous to start with continue to look for a safe haven to park their money until markets return to a more predictable behavior. The classic investments in such a case are Treasuries, agencies, and if you have a bit of a longer time horizon, MYGAs with the higher rates, multi-year guaranteed annuities. We'll speak about these later. But one instrument that caught the attention of quite a few in our community in this context is JAAA, the Janus Henderson AAA CLO ETF. As the name implies, JAAA is a AAA risk. Its shares are liquid, it trades at stable prices, and best of all, JAAA shows a 5.54% distribution yield, cash payout yield, at the time of this taping. So, safe, liquid, and high yielding. It's almost as if some kind of financial magic was going on with JAAA. That said, as our regulars know, in real life, it's always higher risk, higher return. So with that in mind, here are the three topics that we'll be covering today. 1. Where do JAAA's 5.54% distribution yield, liquidity, and AAA rating come from, and who might consider investing in JAAA? 2. How do current rates compare for Treasuries, agencies, and annuities? And 3. What are the predicted yields for the upcoming week's Treasury auctions? Let's dive in now, folks. Where do JAAA's 5.54% distribution yield, liquidity, and AAA rating come from, and who might consider investing in JAAA? So, Janus Henderson is not currently a household name in the U.S., although it is well respected in the industry as a mid-sized global asset manager with about $484 billion in assets under management. The firm, as it stands today, was formed in 2017 by a merger of London-based Henderson Global Investors with Denver-based Janus Funds. And some of us, Marcus and I included, may still remember that the original Janus Fund used to be a poster child of the dot-com era around the year 2000. First, for its spectacular gains, and then for its no less than spectacular losses as the bubble burst. Janus Henderson has left those days behind for good, it seems, and is nowadays mostly associated with its flagship JAAA fund, which is almost the exact opposite of the old Janus fund, in that it advertises its low risk, a stable share price, and high monthly dividends, as we said earlier. JAAA, Janus Henderson's AAA CLO ETF, was established in October 2020 at the depth of COVID. It has $25.2 billion in assets, charges 20 basis points in expenses, and invests only in AAA-rated CLO tranches, AAA-rated tranches of collateralized loan obligations. Think of a tranche like a slice of the overall cake, or in this case, a slice of the overall debt. JAAA pays dividends every month, and its trailing 12-month distribution yield, its cash payout ratio, was 5.54% at the time of this taping, very similar to its trailing one-year total return of 5.22%. Which brings us back to today's critical question. At a time when the benchmark 10-year Treasury yields barely more than 4%, how does JAAA manage to generate a 5.54% distribution yield from a portfolio of AAA risks while staying liquid at stable share prices? And the answer is that JAAA does not invest in Treasuries or AAA-rated bonds at all. Instead, it holds AAA-rated tranches of CLOs, or collateralized loan obligations, which are essentially portfolios of loans to companies below investment grade. And if that sounds too confusing, let me be as simple and blunt as possible and say that JAAA uses complex financial engineering to generate a pristine AAA-rated credit risk out of a bunch of junk loans. Let's take an example and walk through how a CLO and the tranching work in principle. First, the manager of the CLO assembles the CLO, which is typically a diversified portfolio of about 150 to 450 corporate loans to non-investment grade companies across maybe 25 to 30 different industries to basically spread the risk. Non-investment grade means to companies whose rating is in high yield or junk territory. A good part of these loans will be to highly leveraged or highly indebted firms that were bought out by private equity firms, but you may find other smaller and or riskier companies as well. So far, so good. A regular non-investment grade corporate loan fund might do the same, and every investor would then own a small slice of every single loan. This means that every investor participates in the success of the entire underlying portfolio, and all investors would earn the same yield on their investment. And this is where CLOs are different. A CLO creates tranches or slices by credit risk. If you assume a lower risk, you get lower returns. And if you assume more risk, you may expect a higher return. The highest tranche, the AAA tranche, is at the top of the hierarchy and will get its share of the interest and capital repayments before everyone else. AAA tranches pay the lowest interest, but in return are designed to experience basically no credit losses in any market, which often translates into 60 to 70% of the underlying portfolio. The subsequent tranches are smaller and mimic various other levels of credit risk. For example, a AA to A rated tranche of 8 to 15% and a BBB to B rated tranche of 12 to 20% would both still be investment grade, but their returns would be a bit higher as they might already see some credit losses in difficult markets. And the lowest tranche, often also the smallest, what is called the equity tranche, would be about 5 to 10% in this instance. This equity tranche will have to absorb all potential credit losses first before the higher tranches are impacted. In return, the equity tranche can usually expect the highest return if loan losses don't go up too high. So how does this work in real life? Well, the industry says that CLOs have a waterfall structure for the allocation of both cash flow and losses. For cash flow, this means that a CLO pools, collects centrally all incoming cash from interest and principal repayments, and then pays the available cash out in sequence, starting with the AAA tranche first and ending with the equity tranche last. In other words, the AAA tranche would get their interest and principal repayments first, and from the incoming cash that remains afterwards, the AA to A tranche would get their interest and principal repayments, and so on, all the way down to the equity tranche. And if, for example, after the AA to A tranche gets their money and there's nothing left over, then the BBB to B tranche and equity tranche would not receive anything. And it works according to the same principle, but in reverse order for any losses that the portfolio sustains. The equity tranche has to absorb all losses first, then the BBB to B tranche, then the AA to A tranche, and the AAA tranche will only be impacted if all the other tranches together have basically been wiped out already. Now, in our example, This would mean that about 70% of all loans in the portfolio would need to default before the AAA tranche would be impacted and see any losses. For comparison, the highest default rates for comparable portfolios during the Great Financial Crisis of 2008-2009 was 12%, and not a single AAA-rated tranche of any CLO has ever defaulted, from what we could find. So there seems to be a track record here that is in line with the initial AAA ratings. And one note about this impressive track record for CLOs: collateralized loan obligations. It sometimes confuses people who remember that similar structured products were at the core of the market meltdown back in 2008-2009. Those structured products, however, were called CDOs, collateralized debt obligations, which are not the same as the CLOs held in JAAA that we're talking about today. The CDOs, or collateralized debt obligations that were at the core of the market meltdown back in 2008-2009, were based on subprime mortgages, which turned out to have a different risk profile from corporate loans when the housing market collapsed. Now, from what we can gather, an estimated 80% plus of AAA tranches of subprime mortgage-based CDOs were either downgraded or defaulted outright during the Great Financial Crisis, which provided quite a shock to the system, as well as a reminder that not everything that's marketed as gold is actually gold. So, always keep your eyes open and keep the nuances in mind. But back to how a CLO works. As I said, it tranches the risk of an underlying portfolio of non-investment grade corporate loans into different slices by credit risk. The highest rated AAA tranche, like those underlying JAAA, offers the lowest interest, but has continued to pay without any losses through good and bad markets in the past. At the other end, the equity tranche will be much more volatile, as it has to absorb losses first in a bad market, but may see equity-like returns in good times, as the name indicates, which also means that CLOs require active management and monitoring by the fund manager. Now, before you rush off to buy JAAA or a similar product, there's one more piece of information that you need to keep in mind. Nearly all CLOs on the market today have floating rates, meaning their interest payments will follow a benchmark. Very often, the benchmark is the 3-month term Secured Overnight Financing Rate, or SOFR, which tracks Fed rates closely, although with a certain time lag. The benchmark is the same for all tranches, but the better rated tranches have a smaller add-on, a smaller spread or premium on top of the benchmark than the lower rated tranches. This means that the dividends you may expect from a CLO are not guaranteed in any shape or form. If the Fed lowers rates, your cash payouts from JAAA will go down. And if the Fed raises rates, your cash payouts from JAAA will go up. In fact, this chart shows you how volatile these cash payouts have been since the beginning. Please note that the bar for 2025 is still missing the December dividend, so it should go up a bit more, but it will most likely remain below the 2 previous years. The floating rate has an upside as well for CLOs though, and that is that their prices remain relatively stable throughout the interest rate cycle. Because their interest rates adjust, prices will not have to rise or fall when the Fed changes rates. JAAA has been trading mostly around $50.50 per share since shortly after its inception, with a maximal downward deviation of about $1.50 in 2022. In contrast, Treasuries or other AAA-rated bonds with a fixed coupon experienced a veritable price roller coaster around COVID, first up, then sharply down. Many in our community still vividly remember the red numbers that they saw on their account screens. So, where does this leave us, and how do we in the Lammer family think about a potential investment in JAAA? Now, we don't own any shares currently, but we could see a case for adding some JAAA to your portfolio if you like one or more of these qualities. First, the current high distribution yield. the attractive cash payouts, basically. For comparison, JAAA's trailing 12-month distribution yield of 5.54% per Morningstar is a full 1.21 percentage points higher than the 4.33% for the iShares Treasury Floating Rate Bond ETF, TFLO, which holds broadly comparable Treasury floating rate notes. Second, the low underlying risk with a perfect track record of no historical losses for AAA rated CLOs, even during the Great Financial Crisis. And remember that the track record for similar sounding CDOs, collateralized debt obligations, which are based on subprime mortgages, is dramatically worse, as the market remembers all too well from the Great Financial Crisis. So it's important not to confuse them. Third, the relatively robust hedge against inflation that the floating rate nature of CLOs provides. If inflation were to go up again, the Fed would raise rates, and the interest rates on CLOs would follow. Fourth, the more or less stable share price of JAAA, which reduces market risk and allows you to sell at any point without incurring major capital losses, which is different from most treasuries and other investment-grade bonds with a fixed coupon. And fifth, the liquidity that an ETF provides. And JAAA provides sizable mass with its $25.2 billion in assets. And for those of you who do like these qualities about JAAA and want to learn more about CLOs, including its lower rated but higher yielding sibling, JBBB, drop a comment below and we'll add this to our video list. JBBB invests in BBB to B rated corporate loans that pay higher dividends and are still investment grade, but at the lower end of the range. Remember, higher risk, higher return. On the other hand, we would not consider JAAA if you strongly dislike even one of these points. First, the volatility in payments that a floating rate structure brings. You cannot plan for future cash flows and returns like for fixed coupon bonds or certain types of annuities. Since its inception, total returns for JAAA have fluctuated between 0.53% in 2022 and 8.58% in 2023. Second, the outlook of potentially buying into falling interest rates right now if the Fed continues to lower rates. If that's your scenario, you might be better off locking in current rates with a long-term fixed coupon bond or annuity. Third, the complexity and opacity of a CLO as compared to Treasuries or other AAA bonds. For a retail investor, it's very hard, if not impossible, to understand what underlying firms you're ultimately invested in, and the tranching and structuring on top add even more complexity. In the end, you may need to trust an asset manager like Janus Henderson to have the right judgment. Fourth, operational risk in the widest sense. JAAA, like most other CLO ETFs, need to be actively managed, as we mentioned earlier, meaning that they're constantly scrutinized, monitored, and traded. And there's always the risk that something may go wrong with things like credit analysis, collateral selection, ongoing monitoring, legal documentation, or anything else for that matter. This is another area where you will ultimately have to depend on the asset manager to do a competent and thorough job. And fifth, CLOs carry some other residual risks as well that are not easily hedged within the structure, most prominently reinvestment risk and prepayment risk, which might accelerate falling distribution yields once the Fed starts cutting rates again. Plus, there's always the risk of catastrophic market failure or unprecedented economic dislocations that would render even the strongest track record moot. For example, if the thought of how subprime mortgage-based CDOs collapsed during the Great Financial Crisis keeps you up at night, even though CLOs are a separate product with a different track record, then you probably should not invest in JAAA, but rather consider other alternatives that are by all measures safer, more stable, and predictable, especially if you have a longer time horizon, as we touched upon earlier, bringing us nicely to the next part of our discussion for this week's update. How do current rates compare for Treasuries, agencies, and annuities? As we normally do at the end of the week, let's compare the annuity, agency, and Treasury rates at the time of this taping, going from the highest rates, annuities, to the lowest rates, which is usually Treasuries. For this comparison, we'll focus specifically on rates for multi-year guaranteed annuities, MYGAs, from a AA+ rated insurance company that we work with. AA+ is the best credit rating that an insurance company can get from AM Best, which is a ratings agency that specializes on the insurance industry, meaning the lowest risk, making the MYGA rates that we're about to cover most comparable to Treasuries and non-callable agencies in terms of risk-return profile. And remember that MYGAs work essentially like a CD, similar to a bond, except that they don't pay interest regularly, but accumulate it in the account and pay out everything together at maturity. So, let's begin with some sample rates for MYGAs, which have moved a little bit since last week. Here you have the investment amount for each investment range, from $10,000 all the way up to just under $10 million. And here's a rate for a 2-year MYGA, 3-year MYGA, and so on, all the way up to 7 years. For example, if you were to purchase a $10,000 7-year MYGA at the time of this taping from this AA+ carrier, your rate might be 4.4%. A $50,000 7-year MYGA might earn you 4.5%. A $100,000 7-year MYGA might earn you 4.65%. And a $1 million MYGA might earn you even 4.7% for 7 years. And if you have more than the amount shown here, say north of $10 million, your rate might go as high as 4.8% with this AA+ insurance carrier this coming week. So 5 basis points higher than last week across all investment ranges for the 7-year MYGA. The rates for the 6-year MYGA are even 10 basis points higher than last week, while the rates for the 2-year MYGA and the 5-year MYGA have stayed the same. And the rates for the 3-year MYGA and the 4-year MYGA have gone down by 10 basis points, though. Annuity rates track interest rates and so continue to be at above average levels when you compare them over the most recent 20-year period. Do keep in mind the MYGA rates in this table are subject to change at any time without prior notice, and that your personal rate may be higher or lower depending on a number of factors, including how strongly or not so strongly the insurance company you're buying your annuity from is rated, meaning how risky or not risky your insurance company is. As I've already mentioned, it will also depend on your investment amount, annuity type and term, state of residence, and other circumstances. Your personal rate is not fixed before you sign your annuity contract. Now, let's move on to non-callable agencies and Treasuries, both of which are more liquid than MYGAs in the sense that you can sell them on the secondary market before maturity at whatever the then prevailing market price may be. Remember that MYGAs usually only allow you to withdraw some part of your capital per year without penalty, for example, 10%. So, as this table shows, the rates on non-callable agency bonds range from as low as 3.53% for a 2-year term up to 3.87% for a 7-year term. So lower than last week, with the largest drop in the 5-year maturity, which went down by about 20 basis points for the week. And the rates on Treasuries range from as low as 3.51% for a 2-year term up to 3.82% for a 7-year term. Also down from last week across the maturity spectrum, although not as much as for the 5-year agency bonds. And what we see here is that for a 2-year term and for amounts under $50,000, the rates for MYGAs, non-callable agencies, and Treasuries are all pretty much around 3.5%. For a 2-year term with amounts $50,000 plus, and for anything longer than 2 years, the MYGA rates continue to win over non-callable agencies and Treasuries, and more substantially so the further out you go and the more you invest. So if you're comfortable with the illiquidity of MYGAs, their lack of regular interest payments, and the possible early withdrawal penalties before the term ends, or before you turn 59 and a half, and you want to lock in these MYGA rates for the long run, or if you're considering an annuity for the principal protection and guaranteed lifetime income that they can offer, now may be a good time to reach out to your trusted annuity specialist. Annuities come in many different flavors. MYGAs are more like CDs, whereas FIAs, fixed index annuities, allow for potentially higher market-based returns tied to the S&P 500, for example. FIAs come with full principal protection, but also with an upside cap, and might be something to consider if you want to stay in the stock market for the higher returns, but are concerned that we're headed towards a market correction, as we discussed in these two recent videos on how to protect your money against a bubble. The first-year cap on a 7-year FIA for amounts $100,000 plus still stands at 7.25% at the time of this taping. There are also SPIAs, single premium immediate annuities, which can offer an immediate stream of lifetime income and fixed payments, and QLECs, qualified longevity annuity contracts, which are generally used to lower required minimum distributions, RMDs, defer taxes, and manage longevity risk if you have pre-tax retirement savings. You can check out these annuity videos here, all linked below this video, if you want a deeper dive into who should buy a MYGA, some other type of annuity, or no annuity at all. Or shoot us an email at jennifer@diamondnetsegg.com so that we can connect you with our trusted annuity specialists to see what your options may be. Because as I often say, there is no cookie cutter, one-size-fits-all annuity solution. Any annuity you purchase should be customized to your individual circumstances, goals, and expectations, and fit properly in your overall portfolio, regardless of size. Moving on now to our usual table with Treasury yields from this past Friday versus the previous week, across all the maturities that the Treasury issues at auction. This last row here shows the increase or decrease in rates over the past week. Decreases in rates are shown in red. As I said at the beginning, this was one of those weeks when Treasuries confirmed once again that many investors still see them as a safe haven in a sea of uncertainty and volatility. Remember, when buyers pile into Treasuries, prices go up and yields go down, and that's exactly what we saw this week. All maturities across the board showed lower yields, as you can see from the uniform red on our chart. However, there were some interesting nuances. Both T-bills at the shorter end and the 10, 20, and 30-year at the longer end showed yields that went down only by a few single-digit basis points. It was the maturities in the middle, everything from 2 years to 7 years, that saw double-digit declines in their yields, indicating that these were the maturities that buyers were most interested in. Now, this is a phenomenon that we've seen throughout this year, and while no one knows for sure, our theory is that this is just the time horizon that many investors feel comfortable with at this point. A bit longer than T-bills, which will follow any Fed rate changes quite closely, but also not too long to feel uncomfortably constrained. Of course, as I often say as well, you can also look at the 10-year, 20-year, and 30-year the other way around. If you can live with the uncertainty and think that long-term yields may be coming down again, then now might be a good time to buy some longer maturities to lock the rates in, or to simply add some longer maturity Treasuries, agencies, annuities, or other bonds to your portfolio as you continue to dollar cost average. It really all depends on your personal outlook. In any case, the CME Fed Watch tool still predicts that the Fed will cut rates by 25 basis points on December 10th, with a probability of almost 70%. The remaining 30% bet on unchanged rates of 3 3/4 to 4%. Drop a comment below and let us know, what do you think the Fed will do at the next FOMC meeting? Now, let's take a look at Treasury yields from this past Friday versus the beginning of the year. As before, the last row here shows the increase or decrease in rates since the beginning of this year. Decreases in rates are shown in red. After this week, all maturities are now a bit further down from where they were at the beginning of the year. The smallest yield difference is for the 30-year, but even that has widened a bit again to 8 basis points. All other maturities are down much more. And again, it's the middle maturities from 2 to 7 years that are down the most, between 65 and 79 basis points. But to repeat myself, because apparently I have a tendency to do so, even these lower rates are still quite attractive if we compare them to the average yields over the past 20 years. You can find more details on these Treasury rates for any day of the week that the bond market is open on the Treasury's daily Treasury par yield curve rates page. All sources are linked below in the first pinned comment. Keep in mind that these numbers give you a general feeling for where rates currently stand along the maturity spectrum. The yields that you may get when you buy at a specific auction or from a specific broker, or when you sell, will likely differ a little bit from what's shown here. So, now that we have a good overview of where rates ended the past week, let's move on to the next section of today's discussion. What are the predicted yields for the upcoming week's Treasury auctions? If we go to Treasury Direct's upcoming auctions page, we can see that the 13, 26, 6, 17, 4, and 8-week T-bill auctions are happening as usual. The 52-week T-bill is also on the auction schedule. And if we scroll down, we can see that the 2-year T-note, the 5-year T-note, and the 7-year T-note will also be auctioned off this coming week, along with the 2-year floating rate note. At the time of this taping, on Fidelity's platform, here's where the expected yields stand for the T-bills that have been announced already. The 6-week at 3.876, the 13-week at 3.775, and the 26-week at 3.769. So overall, a few basis points lower than last week. And the 52-week at 3.620. For the 2-year T-note auction, the expected coupon is 3.5, and the expected yield is 3.492. For the 5-year T-note auction, the expected coupon is 3.625, and the expected yield is 3.631. And for the 7-year T-note auction, the expected coupon is 3.75, and the expected yield is 3.807. Please keep in mind that all of these numbers can and usually do change all the way up to the time of the auction. And of course, the bond market will be closed this coming Thursday for Thanksgiving, and it will also close early the Friday after Thanksgiving at 2 p.m. Eastern Time. And as always, if the annuity rates in this table have piqued your interest, do check out these annuity videos here or drop us a note at jennifer@diamondnestegg.com so that we can connect you with our trusted annuity specialists, because annuities are not always straightforward. As I mentioned earlier, any annuity you purchase should be customized to your individual circumstances, goals, and expectations, and fit properly in your overall portfolio, regardless of size. All right, Diamond Nest Egg members, super savers, and course fans, I hope you enjoyed today's video and learned something new. And see you again very soon with more brand new wealth building content for your financial journey.